Welcome to our monthly FX Sheet webinar. Today's topic is going to be finding trades on a daily basis. Those of you who know me, I run bkforex.com along with Kathy Lean. We have a signal service and we have an education. And in addition to obviously being analysts in the forex market and running research and doing contributing editors to CNBC, I am a very, very active trader. I trade on my own account constantly. As a matter of fact, I have multiple accounts. And I'm primarily a day trader. I do not position myself. I look for ideas intraday because I find it difficult to have an edge on a longer-term basis because everything in the market changes so much. So today I'm going to go through just some of my process and my ideas. And this guy IPS Group is not getting sound. So I guess IPS Group, you got to log in and log out to come back in. Everybody else is hearing me okay. Anyways, also, by the way, for anybody who is for some reason having a bad problem with sound or anything else, this webinar is going to be recorded, and the link will be posted, and I'll repost it on my Twitter feed. So no problems from that. But before I start, let me just, as always, do our disclaimer. Past performance is not indicative of future results. Trading forex carries a high level risk may not be suitable for all investors. High degree of leverage can work against you as well as for you. Before you decide to trade any such leverage products, you should carefully consider your investment objectives, level of experience, and risk appetite. Possibility exists that you can sustain a loss of some of your initial investment, and therefore you should not invest money you cannot afford to lose. You should be aware of all the risks associated with trading on margin, and seek advice from an independent financial advisor if you have any doubts. The information, including commentary and trade ideas provided on bkforex.com, should not be relied upon as a substitute for extensive independent research, which should be performed for making investment decisions. BKForex LLC and bkforex.com are merely providing this information for your general information. The information and opinions presented do not take into account any particular individual investment objectives, registration, or needs, and all investors should obtain advice based upon their unique situation before making investment decisions, and should tailor their trade size and leverage for their trading to their personal risk appetite. We're not responsible for any losses incurred on investments made by readers and clients as a result of any information contained in BKForex LLC. We do not render investment, legal, tax, accounting, or other professional advice. And if investment, legal, tax, or other expert assistance is required, services of a competent professional should be sought. So anyways, let me pull up the charts and let's talk about what we do on a daily basis and how things work out. I want to make the chart full screen so you guys can actually see it very well. You guys see the chart well? Everybody sees the euro-dollar chart? It looks like it's being shared. I just want to make sure. Okay, very good. I always want to make sure that everything is being seen well. So to give you an idea of what I do, there are basically three components to my trading process. I look at price, I look at news, and I look at the tone of the market. The color of the market. And I think you need to have all those three components to have an intelligent, effective trading strategy. And by price, as you can see, I look at the purely what I call naked price. That is just pure price. You see my chart here has no indicators. It's got nothing on it except the actual candles that the price chart puts out. And the reason why I do this is very simple. I was actually using this example in our BK Forex trading room today, and everybody loved it. There's 1,000 indicators, right? Everybody has 100 different indicators like to use. The most common indicator is the moving average, right? So everybody, let's just put down a brand new 10-period moving average. We'll put it medium, put it on this chart. And all of a sudden, everybody loves to trade off the moving average. And they say, ooh, moving average is support. Ooh, moving average is resistance here. Ooh, look how well everything hugs, whatever. My view of every single indicator is that it's a completely artificial, manufactured derivative of the price action that's going on. In other words, a moving average is basically nothing but smoothing of this price action, which you can easily see yourself on the chart. More importantly, I think what happens with indicators is that so many people, God, boy, this WebEx thing with sound is driving me crazy. Okay, everybody's got sound now. So many people fool themselves into thinking that indicators have some kind of a magic property, and therefore they provide some kind of a meaningful signal to you as a trader. Most of the time, I think they provide no meaningful signal and are actually damaging to you. And the reason why is because, I gave this example in my trading room today. Everybody seemed to like it. What do we trade when we trade? Do we trade indicators? Do we say, ooh, moving average is 30 point, what's the moving average here? The moving average is 36.22. Ooh, that's a good price. Let me work around that price. No. We don't trade moving averages. We don't get paid on moving averages. We don't get stopped on moving averages. We trade price. The example I gave in my webinar this morning, in my trading room this morning, was that when you walk into a store, right, and you look at a pair of shoes, you don't say, well, what's the moving average for the last 10 days of your shoe prices? And if the moving average is 20, and today your shoes are $19, oh, I want to be a buyer. But if the moving average is 17 and today your shoes are 25, I want to be a seller. I mean, does anybody does that? No. You come in and you see, oh, shoes are $19.95, they're 30% off sale, I'm a buyer. Ooh, shoes are $200 and there's no sales, I'm not a buyer, I'm a seller, right? The point being is, I think we get enamored with a whole bunch of mathematical indicators that are nothing but artificial overlays on the actual price. So the first thing that I like to do is get rid of this. And here I go again. Let me see how I can get rid of this. I always forget how to move this thing off. Oh, I know what it is. I go to indicators and I go delete all, clear all indicators, right? I've been using this software for 10 years. I still don't know how to use it properly. So the point being is that I think you can get very, very fooled into thinking that indicators have any meaningful value to you. Now, there's a lot of people who are going to say to me, oh, what if the price is way away from the moving average, or it's way, way below the moving average? Isn't that a meaningful signal? Sometimes it is, but a lot of times it's not. First of all, remember the critical thing. Let's just take a look. I don't want to pick a moving averages, but I think this is just the simplest and easiest way to look at it. So let's just put, 100 period moving average, right? And everybody loves this, right? They go, ooh, look at how far the price is. It's going to come back up, right? Yeah, maybe it'll come back up, but it was far away here and it didn't come back up. It was far away here, it didn't really come back up. And more importantly, what most people don't understand is that what you see here is not what's going to happen over here. The moving average isn't going to be stationary. The moving average is highly derivative of price. So by definition, it's going to start moving closer. And it looks like price is moving towards the moving average, but it's actually the moving average moving closer to price. You don't have a trade here. This is another very common optical illusion that people have with indicators. The indicator here is completely different from indicator here. Price has not moved towards the indicator. The indicator has moved towards price. So you don't have any legitimate trade idea here. All you have is what's called backward look illusion, that you're basically thinking that the same situation here happened here because you get to see the future on the prices. You go, oh, I would have been so smart if I did this and this here. I would have been so smart because this extended so far away from the moving average. I should have been short over here. That's not the reason. You should have been short here, but that's not the reason why you should have been short here. You should have been short here because price itself gives you tremendous amount of information, and you don't need any indicator to trade intelligently. What is price telling you? This is a 4-hour chart, right? And what we see here is a big move towards the 34 level. And this happens quite a lot where, price will stall at round numbers, right? So here we have price hitting 34s, right? And then moving away from this level. Let's say we're over here. We're now at this particular juncture in our trade. And we're looking at this and we're going, wow. Well, we see it the first time at the 34 level, the price found a lot of sellers. The sellers would not let it go up above this level. There was a lot of offers, right? This is what price basically communicates. So if I'm a guy who likes to sell support and resistance, who basically likes to trade, resistance and support, I'm going to say to myself, you know what? If it goes up into this 33.50, 34 zone, I'm going to consider that to be an interesting value proposition for sellers, and I'm going to position myself as a short around here with a stop. Let's just for argument's sake, because we are broad, we trade broadly. I don't know. Let's just make it, 34.25, just to be reasonable. So I'm going to be a seller at, 33.75 ahead of this 34 congestion level. And if it goes to 34.25, clearly the sellers have been overcome. But if it doesn't, then I have a reasonable chance that maybe it'll come down. And it does. And the price definitely comes down. And you're able to obviously have a successful trade in this particular example where the 34 resistance worked. You could have worked it the other way too. Here's a price that was former resistance. You can see that the 32 level, and generally the interesting thing you'll find on the charts is that the nickels and the pennies are very, very useful. In other words, nickels and pennies are typically where prices, by nickels and pennies, what I mean is 50-cent marks and the 00 marks is where a lot of congestion happens. And the reason why it happens is because, trust me, the people who are trading this market are not trading your moving averages. They're not trading your Fibonacci retracements. They're not trading some obscure, 0.77 to the fifth pip number that you have on your chart that you think has magical properties. They're trading like any guy who walks into a shoe store. Price. Shoes are 50. I'm a buyer. Shoes are 55. I'm a seller, right? They're trading round numbers because that makes sense to them. They are big corporate guys. They're big hedge fund guys. They're looking to make a penny or make 5 pennies, and they're thinking in pennies. So that's why you see prices congest around these levels. Now, not to the perfect extent of it, but within 50 cents of the particular level, they tend to congest. So here's a good example. This is the 32.50 level in the euro, right? It ran up, came back down, found congestion. This is the interesting thing here. This is a perfect example of where congestion was broken, right? So congestion was broken here. That means the sellers were overcome, right? And the price now becomes former resistance, becomes current support. This is very, very important technical construct that is classic technical analysis that really is very, very helpful when you trade. So now, price goes to 32.50, and let's say you're over here, and you say to yourself, last time they broke through this level. This level looks like it's going to be at least a reasonable chance it will be a value proposition for longs. Longs are going to come in and buy because last time they bought through this level, meaning that they thought this was a value level to break through, and now they have a chance to buy it again when the euro retraces. So there's going to be a lot of bargain hunters. So I'm going to get long at 32.75 with a stop 25 below this, all this congestion at around 32.25. And here's a good example of where you can buy support, whereas here you sold resistance, right? And again, the trade works very nicely. Again, you need nothing more than just watching the charts and looking at the price action, looking at the levels to determine what makes sense and what doesn't make sense, right? So that's classic support and resistance. Now, going back to this example over here, what I like to do and what we do in BK is we basically like to trade momentum. We're looking for support and resistance to be broken, for momentum to break these congestion levels, because once those levels are broken, we feel there's a high degree of confidence there'll be continuation. A momentum trader is basically a continuation trader. The trader who believes that there is power behind the move, and once the move clears levels, we have a reasonable chance to continue that move. So in this particular case, instead of trying to sell in front of the 32.50s, we would be a buyer on the break of all this congestion. We would be a buyer on 33s, which we were. We bought the 33s because we thought that was a good breakout point, and obviously the price really had a strong, strong move. Similarly, a very, very powerful area of breakout is the 35s, right? Here's an area. This is the 35 level over here. 35, which is a nickel area. That's like a very, very major. It's half a dime, right? It's half of major area. And it was also, excuse me, guys. Excuse me. It was also I believe a new high for the year. that was going to be a major breakout area. And one of the trades that we did in BK was we bought the 35s because we thought once it cleared the congestion around that area, that was going to really run strong. In this case, it ran so strong, it ran for almost 200 points before it finally found some exhaustion. So we like to buy above resistance or below support from a continuation of moves. But you're welcome to trade, against those properties again. Whatever way you do it, the important part is you need to understand where the key levels in the market are. And then you need to understand what are possible fundamental triggers that could support your thesis going up or going down, and they could make your thesis come true. Because while price levels are very, very important, what is the driver behind all those price levels is the actual news flow, right? Why are people going to do something? Because they have to have a reason. Why do they have a reason? They have to have some news. They don't do it because, ooh, it's a Fibonacci retracement. Ooh, it's a pivot point today, so every hedge fund in the world is going to sell my pivot point. No. Nobody thinks that way except a very, very small subsector of retail traders. The really big money players are trading news, levels, and market sentiment. That's what they're working on, and that's why you really want to reorient yourself in that kind of direction. That's primarily the kind of structure that we do on a day-to-day basis. So, for example, right now, what's happening in the marketplace that's kind of interesting that we've been keeping an eye on, is the Aussie dollar trade, right? Now, the Aussie dollar trade does not necessarily have direct news on the trade. In other words, we don't have Australian news that's extraordinarily bad. But what we do have is a couple of interesting variables that are definitely piquing my interest. First of all, the 102.25s were key support levels that were just broken, right? The momentum just took out the new lows. We just went to brand new lows in the Aussie dollar. It went all the way down to 102s. And the reason we went there was because the news out of the U.S. was actually a dollar bullish. I know this sounds crazy, but Ben Bernanke surprised the market in a way by basically coming out and saying, and again, this is a very, very modest thing, but everything in the marketplace has to do with expectation. He surprised the market by saying that the QE stays in place for now. And just those three words, for now, were enough to convince the market that there's a little bit of a different posture in the Fed. Remember, Ben Bernanke is the most dovish of the Fed presidents. He is generally going to err on the side of accommodation than caution. Yet even he is understanding that there is a limit to the amount of QE that they can print. He still believes that QE must go on. He still believes that we're in a fragile state. But at least he's getting around to the idea. He's envisioning the possibility. He's seeing the future of where QE may become less. That is massively dollar bullish because that means that the Fed is not going to flood the market with dollars, perhaps sometime down in the future, and that's what the Aussie is reacting to. Now, is that going to be enough to push Aussie all the way down to 101, 101.50? Perhaps not. Perhaps this is just a false breakout. But for now, it's certainly one of interest. And right now, the benefit of doubt definitely has to go to the shorts rather than the longs. Because, resistance has been broken. The dollar has found a bid. And, of course, now we're seeing the dollar strengthen. You're looking at the euro. The euro is also flirting around with its 30.50 level. And, if we can break this level, the euro is a little more complicated because it has the 130, quite a lot of support around the 130. But generally, if you get into a situation where the market kind of thinks, you know what, U.S. economy is actually doing much better than the market thinks. We had much better economic data today than the world thought. And yet, the rest of the world is doing poorly. Europe, it looks like it's going to be a mess. And the dollar is going to get the benefit of both being a risk aversion trade, in the sense people take their money out of what they consider to be riskier trades, and also perhaps on an outperformance basis. The one interesting thing that is happening that makes it kind of very difficult to handicap today is if you think it would be dollar positive, how come the yen is rallying? And I think the reason the yen is rallying right now, and you see the dollar yen coming down now, is because the true story in the marketplace, and this is why you have to watch prices as well as news. What the prices are communicating to you right now is that the real big story right now is not necessarily sort of like the idea that everything is hunky-dory in the U.S., but that the U.S. is basically a bastion of safe haven harbor, that things are getting bad across the world. U.S. things not nearly as bad as the rest of the world, so the dollar is attracting safe haven flows. And, of course, when we have a safe haven environment, the yen is attracting safe haven flows because the yen is a safe haven trade. And you're seeing a lot of this unwind in the yen as well as the dollar. So this is really basically a risk-off trade, which is what you start to see when you're looking at all the charts. And that's why it's so important to integrate the price action. And I mean, the price action right now is just pretty amazing. We're getting slammed, right? I mean, just getting slammed on sell points here in the yen and all the way down in the in the euro dollar. Euro yen right now. I'm just watching this as we speak. Euro yen is approaching its its yesterday's lows. I mean, that's a big deal. And there's a lot of selling that's going on. I don't have my Twitter feed on right now, so I'm probably missing some piece of news here that may be causing a lot of this stuff. But the idea here is that we have serious risk-off flows as all of these key levels now are being gunned again. Now, this was a big buy-up level. So here we go. So, 1870, 1870. If we start breaking this level, it's very possible that now, given the way the charts are looking, we're not going to find support till 1800, right? I mean, that's a very, very interesting point. Right now, this is still a support trade. So long as the lows hold here, guys who are, for example, who are support traders are probably coming in here and buying on speculation that this support is not going to get broken. And they have their stop, let's say, at 1850, right? They're going to get long here with a stop at 1850. Guys who are momentum traders are watching and trying to see if these levels get broken, because if it gets broken, then they think there's a reasonable chance to get down to 1800. But that's how you would analyze the price action, the news, and all the chart flow, and start to come up with intelligent trade ideas from both sides of the aisle, depending on your preference of what you want to do. But at least you know what's reasonable, you know what makes sense within the parameters of your own system, and you know the key points of where you're wrong. That's also very, very important. The very, very important point is you have to know the key points where you're wrong. You obviously know you're going to be wrong if you're a support trader and the price goes to 1850. You're also going to know you're going to be wrong if you're a momentum trader and you get triggered on the trade and the price goes back up to probably 1950. If you have that much of a retrace risk, that means there really wasn't that much momentum behind the trade. Now, Ahmed is asking me that there's so much news in a day. Which bit of news is important? Day is hard to follow. It's a good question, but generally, the rule of thumb is you'll be able to see, where the major headlines are. First of all, you can just simply look at what the major headlines that everybody's talking to on CNBC and Bloomberg are. You also know, of course, that the Italian election story is a big story. You also know that Ben Bernanke testifying is a big story. I mean, these are big macro stories. They're always going to be much more important than some kind of a small piece of economic data that comes out in the middle of the day. The longer you stay in the most market, the easier it is for you to identify, which are going to be the important levels and which are not, in terms of the news flow. Somebody's asking me my opinion on gold. I'm happy to take a look. Oh, where's my gold? XAU, right? Now, gold is kind of rallying. This is kind of interesting. And gold obviously had a massive, I honestly, I don't have a fundamental reason because I don't really follow the gold market a lot. I've been bearish gold because I think, generally gold has not been a very, very good inflation hedge or a problem. The fact, I guess, maybe they're talking about, I really don't know what Bernanke's talking about right now, so I can't make an intelligent assessment on why gold is having this big, big rally right now. But gold broke a lot of technical support levels. Right now, from a technical point of view, gold still looks like it's a sell. As a matter of fact, if you are support sellers, the 1620 level, this congestion level, is obviously a big support level, big resistance level for gold. If gold breaks this, then the next level of attack would be 1650. I definitely think 1650 was going to be a much harder level for gold to overcome on a sell basis. But this looks to me like a short covering rally, and just like you had a very, very severe liquidation rally, you could have a very steep short covering rally. The reason why is because gold is very illiquid, and therefore the moves in gold can be very, very sharp depending on which side of the market is trying to cover its position. Boyke is asking me if I trade on the 5-minute or do I trade on the 4 hours. It's not. I'm just simply showing charts on the 4 hours because I want to show major, support and resistance points. I don't really trade on a timeline. I trade on price levels. I couldn't really care. Time is also an artificial construct. I mean, does it really matter whether you're looking at a 4-hour chart or a 5-minute chart? What you're going to see is congestion. If you have a big enough chart, you'll see a congestion at these price levels in the 5 minutes, and you'll see lots of movements at these price levels on the 4 hours. The main thing is I like the 4-hour chart because it gives you a comprehensive view of the price action and gives you a better clue of where the key levels are. But again, time is of absolutely no importance to me. Time is another completely false construct. Because remember, price can go 100 points in 5 minutes, or it can go 100 points in 5 days. What does it matter? 100 points is 100 points. The key thing is to try to bang those, right? So, any more questions on any particular pairs that you guys want to take a look at? Aussie CAD. Aussie CAD is a kind of a tough one. It's been a tale of two losers. So the other thing about Aussie CAD, and I've been bearish Aussie CAD for a long time, but the problem is the Canadian part of it has really not cooperated with this trade. But as you can see, this is a great example of support at play. The 105. 106 level, and those of you who heard me deliver, those of you who were with us at the New York Traders Expo, heard me deliver a very long kind of a thesis on the Aussie CAD, and I said the critical level of support or resistance in this particular case for this trade is the 106s. As long as we don't break 106s, it still remains to be a short. And of course, coming in here between 105 and 106. Looked like it was a pretty intelligent trade because so far that's really where we're finding, major weakness. The problem with the Aussie CAD trade is that you would assume that dollar CAD would perform better than it does. Dollar CAD has really performed much worse than everybody thought, despite the fact that you have much higher oil prices and much higher generally much better growth in North America. But that growth in North America is not translating to growth in Canada. And the higher oil prices have not been really banked in by the Canadian oil companies. So as a result, you basically have this massive squeeze higher in the COM dollars, where the Australian dollar is not differentiating itself from the Canadian dollar is not differentiating itself from the Australian dollar, and the Kiwi dollar, is basically doing the same thing. It's just falling to the wayside. The Kiwi dollar today, specifically, here's a great example of a momentum trade. Those of you who are in our BK Forex signal service know that I sent out our daily technical research piece where I said the 83 level was absolutely key in the Aussie, in the Kiwi dollar. A break of the 83 opens up a full run to 82.50. Where do we go? We broke 83s here, and we took all the way down to 82.23. That was a very clean, very effective, and very classic momentum trade to the downside. So that is, I'm sort of diverting from the Aussie CAD, but the point being is all the COM dollars are down. But if you believe that there's going to be if Aussie CAD is signaling to you further weakness, and let's go back onto the dailies, and we see, you see this. There's a lot of chunkiness here. This 102, right? Obviously testing 102. 101.50 is a very, very key support level here, right? It's really flirting around with this. There's a lot of value buyers here. So Aussie, breaks 102, probably has some buyers at 101.50. But if it breaks this 101.50, that is off to the races. That's basically all the way down to parity as the Aussie starts to really unwind to the downside. So, I like this trade. If it comes down below 101, like 101.35, you have a reasonable chance here to possibly push it all the way down to parity because there's nothing beyond this 101.50. Those who are going to be more speculative and more aggressive can consider shorting this at 102 and hope that it makes its way out down to 101.50 and then breaks the support level. That'd be the perfect trade for somebody who's trading momentum. Euro yen broke a ton of very, very important support levels. Euro yen did a tremendous amount of damage yesterday. And more importantly, look what the euro yen is doing today. This is a pretty negative candle, right? Now, the euro yen right now, to me, if I wanted to trade this thing, is a sell on the lows, right? So 119 found a little bit of buyers here, and we popped up, right? And 118.77 or 118.70 is basically the lows from yesterday. I think those are areas very vulnerable. So we break 118.70. You really don't see much support until like kind of 117, and then not really serious support to 115. Can euro yen go down to 115? Yes, it can really surprise a lot of people by unwinding much fiercer and stronger than people think. And it can do that by the euro breaking down through the 130 and the dollar yen going down to 90. You know, because a lot of people are still believers. This is the key thing we know. The big thing with trends is nobody wants to believe trends end, and they try to come in and start buying the dips. The problem is when the trend gets mature and you're buying dips, you're actually buying a sucker trade. I don't know if dollar yen is a sucker trade right now, but it's certainly starting to look that way. I mean, if you're looking at dollar yen right now, which is a very key component of this euro yen trade. We had a big break. 91 really, is key support. 91 gets given here. We're trading. If we trade below the 91 level towards the 90.84, that's very, very ugly. That basically takes us all the way down to 90, and it takes us in euro yen somewhere towards the 117 level initially. Mr. C is asking me, what is my platform? The charting platform you see here is IntelliCharts, which is a very, very good platform, and one that I like, but it's a pay-per-view platform. And as far as my own trading, I trade on FXCM's Active Trader platform, which I like very much, which does a very, very good job of execution, and it does a terrific job in terms of my reporting. And I'm sort of kind of the, excuse me, end the show with my Twitter feed, which is at FX Flow. Feel free to follow me if those of you who don't. I post a lot of interesting information here on an hour-by-hour basis. It gives you a chance to kind of look at what's going on in the market. It's basically my own running commentary of what's going on in the marketplace. If you have questions, I'm happy to answer them. And actually, I want 2 more followers so I can go to 13,000. So if you guys are not following me, do me the favor and follow me right now. Turn me over to 13,000, and then I will be a happy puppy. If you're interested in what we do at BK, simply go to the BK forex.com website, and all the information is here. There's lots of interesting reading material, and you can learn exactly how to trade, and you can trial this out for $59 just by simply clicking this button. So there's a tremendous amount of information here. There's lots of really good trade ideas and strategies, and I welcome you guys for coming in and trying us out. So come visit me on Twitter. Come visit us at BK, and hopefully you get an idea of how we trade. Any more additional questions that we have before I have to go? Looks like it's not. Looks like everybody is good. Oh, pound retracement to 156. Okay. Let's take a look at a pound retracement to 156. I think 156 is a tall order. I think cable is, cable had this kind of a dead cat bounce to 52. It's looking kind of ugly right now. To me, cable is an interesting sell below the lows here because if we can clear the lows, I mean this is a parabolic fall. It's a very, very steep fall. So you're right that eventually it's going to be a pretty sharp short covering rally. I just don't think it's going to be there just yet. If we hold the lows here, let's say we have 2 or 3 days where these lows are not broken, then I would be much more towards your bias. I would say, you know what? I think cable maybe a short-term bottom, and I want to try to buy, and maybe even if it clears 53. It has a reasonable chance to go back up to 55, which was the major shelf level before. But next 2-3 days are critical. We start breaking the lows here. I think we have a very strong possibility of trading towards the 150. And Arvind has asked me, do I trade gaps? And the answer is actually I do not trade gaps because gaps are very, very dangerous both ways. We can see, we've talked about this actually in our trading room in BK today. I prefer to stand down from the gaps. So whether you want to, runaway gaps are very rare. So typically, whenever you have a gap, you really don't want to be selling, behind the gap because you very frequently get this kind of retrace action. But at the same time, the retrace action may not be nearly as strong enough to give you any kind of reasonable trade. I like to watch and have either gap filled and then the levels tested. A very, very good example of how the gap got, here's a gap, opens up, we didn't do anything, but then once these levels broke, the 193 level broke, this is way beyond the gap, then it presented a very interesting sell opportunity here yesterday, and obviously that created a very, very strong sell to the downside. I'm just watching all of this price action. Is clearly seems to be. Somebody's asking me, do I look at currency correlations in other markets before trade decisions? No. The beautiful thing about currency correlations is the moment they become obvious, they become obsolete. You obviously had very, very strong correlations with the euro and risk and everything else. And euro yen used to just follow Dow Jones continuously, and you could trade those ideas. But I think the problem with that is that you don't know when the party ends, and by the time you figure out the party ends, you kind of lose a lot of your money because the whole definition of the party ending is that the stuff doesn't work. And I don't look at the dollar index at all. Dollar index is another fictitious creation that has absolutely no bearing in the currency market, or not in the real currency market. Somebody's asking a great question. How has FX evolved from the time I started trading to now? The most important thing I think right now is that FX has become much more competitive. The pricing in FX has become very, very tight. Right now, if you're trading on active trader spreads right now, I'm looking at my spread. It's 1.2, 1.3 in the euro, all in. 1.1 in the pound, 1.2, 1.1 in the yen. These days, if your platform isn't giving you, 1.5 maximum spread, then you're probably trading with the wrong platform. And that's a huge advantage because the tighter the spread, obviously the more precise your trades are, the greater the probability that you can make your targets and things like that. I think the market has also gotten a lot more sophisticated, and the market has gotten much faster. And I think constantly you have to be much more on your toes with this market. It was, I think, gone are the days where you could just put on a trade, close your eyes, and come back at the end of the day. You have lots and lots of different things that are moving all the time, and you have to be in the market all the time to kind of fully appreciate it and take advantage of it. Okay, guys, I got to run. I'm sorry, I have another appointment. This will be recorded. Come visit us at bkforex.com. I'd love to see you there. Take our trial membership. Come visit me at Twitter and turn me over to 13,000 followers. And if you have any questions, it's contact@bkforex.com. Let me just chat that out to everybody. And feel free to email me there anytime you like. Okay, I thank you so much, and I will see you next month. Take care, guys. Bye-bye.